Alrighty guys, welcome back to my YouTube channel and my video. This is Wilson, and in this mini course that I'm putting together here on YouTube, this is part one. It's the basic guide to day trading and momentum trading. So if you're somebody that's looking to make some money in the market, you have a little bit of cash to spend on investing and day trading, this will be a good starter guide for you. If you're more advanced, you probably already know everything that I'm going to be covering in this mini course. It's absolutely free, and it could be a good refresher for you if you already know how to day trade and stuff. But you can follow me anytime at it's Wilson8 on Twitter, or just subscribe to my YouTube channel, and please do that. So getting right into it, the most basic way to do it is, of course, in the beginning, you need to choose a brokerage that allows you to place trades, place orders on a day-to-day basis because you're going to be day trading. There's a lot of different brokerages out there, depending on where you live, depending on the trading level that you're planning to do. For example, are you trying to do options trading, etc.? Do you need a margin account? Different brokerages have their pros and cons. So not every brokerage is the best. There's no best one. I personally use E-Trade. I have friends that use everyone mentioned in this list right here. But it really comes down to your trading strategy. How often will you trade? How much of a capital do you have? Because some of these do have a minimum deposit. Choose one that works for you. Do you need some of the tools that they come with, such as their trading platform for you to do your technical analysis? All these little things come to play. But in the beginning, all my friends, and what I would recommend is to just use Robinhood because there's no commission. So in the beginning, when you have lower capitals, the problem is that commission fees take up a lot. So each time you make a trade, you buy a stock and you sell a stock, you buy an order and sell an order, there's a commission fee. So the Robinhood is the only way to avoid that out of all the platforms that I'm mentioning right here. There are other ones that do as well, but Robinhood is the most popular one, and it includes pretty much most of the stocks except for some of the stocks that aren't listed, like really low penny stocks. But Robinhood is great, and they also have Robinhood Instant, where you can actually get up to $1,000 right away to trade, so you don't have to wait for it to transfer from your bank account into your brokerage. I personally use E-Trade. A lot of my friends use Fidelity. SureTrader is for more of those advanced traders, but the great thing about SureTrader is that it has that 6 leverage, so 1 to 6. So if you put in like $500 in it, there's a 6 leverage that you can use on margin, which gives you more capital because a lot of times you want a bigger position in a stock in order. I mean, if you're only making, let's say, like 10 cents per share on your trades, then you don't even have enough to cover the commission fee. So if you have a smaller account, just go with something like Robinhood in the beginning and kind of gauge the market, see if trading is for you, and you can make trades. So choose a platform that works for you. A lot of popular traders like Interactive Broker because of the solid commission fees and is reliable. But that's totally up to you. Just start with one, put the minimum deposit. Most of them, the minimum is only about $500. That's not too much money, and it's really not going to be a lot for you to hold a big position, but it's a great way to see, hey, I can probably buy 5 stocks of Apple, especially with how Apple's trading quite low right now, and then see if it goes up. If you make some money, sell it, and then find the next stock. So here are some of the key terms that we'll be going over that you need to know for day traders. The first one is volume. Volume is what you hear everywhere in every chat group, every forum, every blog post. You see it everywhere. It's pretty much how many shares are being traded in the market at that current time, right, on a given day. So as a trader, we want to only, especially as a momentum and day trader, we only want to target stocks with high volume, because low volume means that there's no movement. And when there's no movement, nobody's buying, nobody's selling, the price won't move. There's no liquidity. So because of that, you could be stuck. That's why you see so many stocks, they're stuck. at like I don't know, $5.50, and they only go up and down throughout the entire week by like 2 or 3 cents. That's not what we want, right? When it comes to day trading, you want volume because you want to make money quick. So you want stocks that would jump up in price, and that's only if there's enough popularity, which is volatility, volume. The next key term you hear a lot of day traders talk about, which is float. This is very, very important. One of the mistakes that I made when I first started trading was that I ignored float, right? So I did find stocks that were relatively high in volume, but they were also super high in float. So float is the amount of shares that is out for in the market for people to trade. That excludes the equity that someone like the directors or the CEO owns, but it's pretty much the amount of shares that are out there. Now, as a day trader, what are we targeting? What is the float size that we're ideally looking at? Ideally, from my experience, you're looking for something under 100 million. The lower, the better. Not ridiculously low, but like if you can find something like 20 million with good volume, then that means the price will be moving, and that's a stock that you need to monitor. So in part two, when we go over picking stocks, one of the things that I will be talking about is how you have to find a good relative volume where the volume matches the float so that you know that the price will be moving and you can monitor it on a day-to-day basis, right? So it's very important to know the float. Now, the bad thing about float is that most of these stock screeners or trading platforms, they don't show the float. So it's really hard to screen for a stock that has low float and high volume. Um, Finviz.com is one of the screeners that I use. If you guys haven't checked that out, you guys can check out my other video where I talked about how to screen for swing trades. But that's one of the websites that actually show the float of a particular company. The next key term is short selling or short stocking, which is when an investor they pretty much borrow money from the account, so you're margin trading, and then you sell the stock. So for example, let's say there's a stock trading at $1.50. You think it's oversold. You see the candlestick going up. It's all green. It's been a big spike from $1 at the opening to 150, and you know the stock is going to go down. But what you can do is you can bet against the market and you can short sell. So you're borrowing money to sell the stock. Now, if the price drops, then you're making money every cent that it drops, right? Every time that it drops, you're making money. So that's how you profit from short stocking or short selling. But the problem is that you also have to buy back the stock, and that's what we call buy to cover, to buy back the pretty much between whatever the margin was that you made. Now, if the stock decides to go up from 150 to like 160, then you're going to be losing that 10 cent per share. So it's kind of like buying a stock and watching it profit, but except you're just predicting that it will go down. And it's very dangerous because if it keeps going up and you don't have a good risk management, then chances are you're going to be losing a lot of money and your account can go into negative balance, which is not what we want in day trading. Next key term, you probably hear this quite a lot. It's called OTC, which is over the counter bulletin board. That's the full name, OCTBB. People call OTC stocks that are pretty much stocks that aren't listed on the NASDAQ or New York Exchange. And most of these stocks are usually like penny stocks, like literally penny stocks. The penny stocks is kind of widely used, that term, because some people refer anything under $2 as a penny stock or a dollar. But OTC stocks, we're talking about literally like they could be worth 1 cent, 2 cent, 3 cent. The thing is that we don't have much news on these companies. These companies probably we just can't really predict, right? So it's a huge gamble. But let's say, but they're so cheap that it allows you as a day trader to buy like 20,000 shares for a couple $100, and then you can see a huge profit if it just jumps up by 2 cents, right? But the downside is that you can lose everything. There are some brokers that allow you to trade OTC, such as E-Trade. This is why I love E-Trade, because they have OTC stocks. But like for example, for Robinhood, a lot of OTC stocks you will not be able to trade. So that's another thing that you have to consider when you're choosing your brokerage. So when it comes to day trading, the first thing that every day trader should do is that they should watch the SPY, which represents the S&P 500, and it represents the entire market in general, all the stocks that are listed. The good thing about this thing is that you can see which way the market is going, right? Because market goes up and it goes down depending on the day. You're not going to have days where the market jumps by 10%. If it does, that means that most of the stocks are probably going to be doing relatively well, and you might see new highs for a lot of stocks. So it's really good is a wise choice to monitor the S&P and see which direction that the market is going. You can do this right when the market opens, or you can do it even pre-market by looking at the futures. Almost every single stock or finance news site that you come across will have the SPY listed on there. So you can check out MarketWatch.com, Yahoo Finance, and breaking news can cause the market to spike. So even though most of the market moves within the first hour or the first 30 minutes of opening, right? That's where you see the most order goes in, and this is where a lot of day traders take advantage of the momentum is during the first hour, or maybe even max the first 2 hours. But that doesn't mean that the market never moves midday or past midday, right? So any type of breaking news, like some sort of merger, some company signed a new contract, that can move and spike midday. But watching the SPY is super important to kind of gauge how the overall stock market is doing in the direction that it's headed. The next thing you should always do as a day trader is track all your trades. It doesn't have to be difficult. You can go old school and use a pen and paper. I like using an Excel sheet. I just created this absolutely free using Google Drive, so it goes with me everywhere. I record everything. I record the price that I bought the stock in at. I record the price that I exit the stock at. I record my gains and loss, my percentages, and the overall portfolio growth. If you have a smaller account, you don't want to focus on the amount of money that you made. So for example, if you only deposit 1,000 and let's say you made $100 that entire month, you might be like, hey, $100 is not even going to pay my bills, which is true, but that's like a 10% portfolio growth. That's a 10% profit that you made. So it's important to record every single day and see what are your gains and loss, and grow that account over time by percentage and not focus so much on the exact number of dollars that you have made. The next thing is, this is what makes a good trader different from a bad trader, is risk management. Because the most important thing when it comes to trading stocks is having a good risk management strategy. And in part 3 of this mini course, I'll give you guys a detail along with examples of how to create your own risk management strategy. But it's crucial. I mean, it's just like if you're starting a business, you won't want to run into a business without a solid plan, right? You need to have your good profit margins. Like, you want to purchase good inventory at a low price and sell for a higher price. It's basic business. So just a rule of thumb without getting too into details is that for every $1 you're risking, you want to gain $2 on the market. So if I'm entering a trade, I want to be able to double my profit on every single trade and only risk one of like half of what I'm going to gain. And if you have this strategy and you make 10 trades a day, even if you only hit, if you hit 6 of them, you're going to be profitable, right? Even if you're not the best at choosing stocks, but with good risk management, you know when to get out, you will be profitable in the long term, even without knowing the market, without knowing how to choose a stock. So have a good risk management strategy, which we'll go over later. The next basic thing is the different types of order types. So the two main type of order types is market and limit. A market order is a buy or sell order that executes immediately at the current market price. I never do market orders because they just never give me a good price. the brokerage takes a big spread and they take the commission, and then and every little cent matters when it comes to day trading or momentum trading. So as long as there's enough sellers and buyers in the market price just gives you whatever the best price they think it is, right? So for example, if let's say Disney was trading at $98 right now, if I place a market order, they might give it to me at like 98.99 or 99 bucks, which is not what I want, right? I want 98, or I'm maybe willing to pay like 2 more cents, like 98.2 cents. So I will put in a limit order for that, and that's what a limit order is. A limit order is where you set your price, and if it doesn't get you a better price or the price that you specify, then the order will not execute. Now, there's a downside to limit orders, which is a lot of times orders don't get executed. So there's a strategy that you can use where you bid a couple cents higher uh, than the ask or bid price, and to get your order executed quickly, and you still get a better price than a market order. I'll be going over the strategy a little bit more in depth in later parts of this course, but for now, just know that limit order will get you a better price for whatever you specify. So I always use limit orders even when I'm buying or if I'm selling. The next type of order types are a little bit more advanced, but it's very important to know as well. So there's a stop limit, which is a must use for all day traders. I don't even think you need to day trade. You swing trader, long-term investor, you have to know how to use stop limits because you have to manage your risk. So what a stop limit allows you to do is set a price where if it goes anything near this price, like let's say I bought AMD shares for $13 and it jumped up to 15. Now at let's say $14, I want to make sure that I don't lose anything more than that, so I can keep my profits. So I would set a stop limit at 14. So if it hits 14, then it will automatically execute and sell my stocks. Another thing is that when you're entering a trade, especially for the ones that are jumping up and down really quickly, you want to set a stop limit with your good risk management strategy a little bit below what you bought in as, so that if it does go low, you manage your risk and you don't lose as much money. So stop limit is the most important thing, and I use it for almost every single one of my trades. Trailing stop is a little bit more advanced, but it's for people that are usually on the go. So what it does is that you can set a certain number, either as a percentage or as actual quote. And what you're saying is that if the market continues to go up, if the stock continues to go up, then let me hold my profits. But if it drops $2, so let's give an example. Let's say Facebook's trading at 100 and it's still going up to 103. Let's say you had a trailing stop for $2. Then that means that if it drops to 101 from 103, then execute my order. But if it keeps going up, then let it go up. So if it goes to 106 and your trailing stop is $2, then that means sell my stock at 104 instead of whatever it is, so that you can keep your profits. Then there's sell limit, which is sell at a better price at above the limit. And then there's the buy to cover and sell short, which is what I talked about, where you short sell a stock and you have to buy back the cover. It's more advanced. Since this is just a beginner's video, we can skip this for now. The next thing day traders need to know is that there is this thing that is very annoying. Everyone deals with it in the beginning. It's called a PDT rule. So it's a pattern day trader rule. And it's pretty much saying that you cannot day trade more than 3 times a week. And that will restrict your account for 90 days. The restriction could be anything from a scratch to your back, or it could be 90 days restriction where you can't get funds out and you can't sell stocks, right? Which is not what we want. Now, there's a lot of ways to bypass this rule, such as not trading your entire purchasing power. So if you have like $2,000 in a brokerage account, you can just trade 500 of that every single day and repeat that cycle so that you don't really hit the 3-day trade limit. You have to wait for the funds to settle pretty much. The other way is to have $25,000 of active trading amount in your account, and that will allow you to day trade all you want. So the 25,000 one doesn't work for most people that's starting off, because you, especially if you're new to trading, you don't want to put 25,000 into trading yet, right? Until you're more experienced. So it's a very difficult rule, and it kind of prevents people from day trading. And the regulations consider a day trade as if you buy one today and you sell it the same day, which is what we're doing, right? Momentum and day trading. So there's this is a very annoying rule, but it's what affects and stops a lot of people from day trading. The next tip I would have is to always read the news. Yes, I hate reading the news myself. I think it's super boring, but it's necessary for a trader to keep up with the news, and it's also very necessary to always be learning, right? We have to react to any type of catalyst, any type of press release, and that can make the stock jump. Okay, that's the stocks that I like to trade. I don't like to trade. I'm a technical trader, but I don't like to trade stocks that just have a technical breakout, like a massive spike for no reason with no news. That's just not safe for me, right? And those stocks I would never swing trade, so I'll never hold overnight. But if there's a good news, it could mean that uh, the stock will remain going up for the next couple of days, or the volume will continue. So it's very important that we keep up with the news and see how the overall market is doing. For example, if you only trade gold stocks and the gold price is dropping every day, then chances are the stock price will drop as well. It's not that you made a bad choice. I mean, it's just that you didn't keep updated with the news. So there's a lot of ways you can keep up with the news. You can check out sumo-.com, which gives you market updates and analysts. MarketWatch.com for the pre-market news and their breakout news is. TheStreet.com, CNBC, Yahoo Finance. Now, I'm not telling you to listen to the advice from CNBC and The Street and stuff like that. Just read the news. See what's going on in the world. And if you're in the market, you want to know how your stocks are doing, so you know you can exit early if there's something bad, or you know you can jump onto a bandwagon when something is doing really well. So always read the news. Another tip I would have for new traders is that there's going to be a lot of terms that you're going to come across that you see a lot and you just don't understand what it means. The best way is to look it up on Investopedia, which is the site that I get all my information about. So if I don't know what is shorting a stock, I would look it up on Investopedia. It's probably one of the most reliable, non-biased stock sites that you can go. It's pretty much an encyclopedia for finance. Another thing to stay on top of the market is by signing up for newsletters and getting the latest updates on pre-market and post-market. So that's it for part one. Next up is going to be part two, which I'll be posting probably tomorrow. And it's going to be on how to pick the best stocks for day and momentum trading. So we'll go through how to screen stocks. You can also take a look at the video that I posted up yesterday, which is about how to screen for day trading using FinViz and other screeners. Then in part two, we'll also talk about how to scan for stocks pre-market, so you know what stocks to add to your watch list, how to set up your watch list. We're going to be talking about risk management. Like I said, it's very important how to come up with strategies and actual examples that I use. And we'll go over some examples of a few successful trades. So that'll be up in part two. Hopefully, we'll continue going to part three, part four, part five until the course ends. So if you like the video and you want to stay updated, make sure you hit that subscribe button on YouTube and the like button. Much appreciated. You can also follow me on Twitter at iswilson8. Well, take care, guys. Hope you guys like this video.